Michael Pearson is probably smarter than you are. He is definitely smarter than I am. He was a director at McKinsey, a very fancy consultancy, and he graduated cum laude from Duke, a very fancy school. Ditto Bill Ackman. He runs a huge hedge fund, and he was cum laude at Harvard. So how is it that Mr. Pearson was running Valeant and Mr. Ackman was the biggest investor in it when it did this? That is $80 billion flapping up to money heaven in just 8 months. $11 billion in value disappeared the day the company cut its targets again. Surely smart people can prevent this or get out of the way. There were warning signs. Valeant was a roll-up. It grew by buying other companies, at least $37 billion worth in the last 8 years. Roll-ups often crumble under the weight of their purchases. Look at Tyco, which blew up 15 years ago after a string of acquisitions that would make Valeant jealous. Valeant reported its financial results after lots of non-GAAP adjustments. Until recently, for example, it reported something called adjusted cash flow, an oxymoron. The whole point of cash is that you can't adjust it. Groupon, another notorious adjuster, acts as a helpful comparison in this context. Valeant also seemed to find growth and profit where other companies could not. Valeant's business model involved buying neglected products and companies, squeezing costs out, and making them grow faster. But if this was possible, why didn't the old owners do it? Were they so stupid? One thinks of the revolutionary but mysterious business models of, say, Enron. So that's not so tricky, is it? Well, maybe. Pfizer is a long-time serial acquirer, and it does okay. All the big social media companies make large adjustments to reported earnings. Apple's sustained profitability is quite unlike anything seen before in consumer electronics, but it's not a trick. The problem is not seeing the red flags. It is determining which ones to ignore. Rob Armstrong, Lex.